The reason finding great stocks is so hard is because of this. A lot of people are focusing in on the tiniest details without considering what's most important first. It would be like obsessing over the seasoning when the meal itself is terrible. And sadly, by the end of this video, many of you are going to realize your hunt for stocks is so difficult because you're focusing on these tiny details first and totally missing the bigger picture. But luckily, you're also going to learn the solution to fix this, which if you'd followed 5 years ago, would have brought you an average return of 236%. Because there are just 3 metrics we can use to help answer 3 vital questions for finding great stocks. So let's start with the first question, which is how to identify businesses with high growth potential. Because I think there's a real problem with how people approach investing, and although I love Warren Buffett, it's a little bit his fault. Because like it or not, Buffett is synonymous with value investing. And if you've studied anything about Warren, you'll have heard about his famous cigar butt strategy that he used back in the 50s, where he'd find companies with one final puff. What this means in reality is that Warren would find pretty crappy companies that the market had fallen out of love with, but which were nevertheless still very undervalued. Often even valued less than the actual net assets the company owned. So Buffett would invest not based on the business growing, but on the inevitable correction that would occur once the market realised how undervalued these stocks were. At that point, Buffett would sell, and then rinse and repeat the same strategy. It was a stroke of genius. But it's a terrible approach for most investors to take today, and notably, an approach that Buffett himself hasn't taken for decades. But I think this famous strategy has left a hangover where investors try and find extremely undervalued and contrarian companies and completely ignore the fact that they have zero growth potential. It's a gigantic risk, and it's one that could totally ruin your portfolio. What we need to do is find a metric that indicates a company is going to grow. Because if the company grows, the share price will grow, and so your investment will grow. And a couple of different approaches might pop into someone's mind right now. Maybe looking for companies that have experienced previous share price growth, or companies that sit within industries with high growth potential. But both of these would be risky places to start your search, because historical share price growth doesn't mean that growth was justified, or that growth will be sustained. It could purely be based on hype that never materializes. And even if you did correctly identify some high growth potential industries, that doesn't tell you which companies in that industry are best placed to take advantage of that situation. But there is one metric that goes a long way to answering both of these questions, because one of the best indicators of future growth in the business is its historical revenue growth. In particular, its revenue growth over the previous 5 years. Because if a company is growing its revenue, it means it's growing its sales. And if it's been able to do that year after year after year, it's much more likely to be able to continue that growth into the future. And this isn't just me making stuff up. I've been working in data analytics and data engineering for the last 10 years, so I take a nerdy analytical approach to pretty much everything. And if we take a look at the USA's 100 largest companies back in January 2019, then take their 5-year revenue growth as it was at the time, and then compare that with the share price growth from 2019 to now, we'll find there is a correlation between the previous 5-year revenue growth and the following 5-year share price growth. In fact, it's quite a decent correlation as financial correlations go. And if we filter down those top 100 stocks in 2019 to those who only had a 5-year revenue growth above 50% from 2014 to 2019, we're left with 18 companies which fit that criteria, and an average share price growth rate since then of 419%, which sounds great. But there's a problem. Within those 18 stocks is Nvidia, which experienced share price growth of over 4,000% and so totally skew the results. And if we remove them, the average comes down to 174%. Still pretty good, but out of those remaining 17, 2 of them actually decreased in value, and it was only just over half of them that managed to beat the market. So using the 5-year revenue growth alone isn't perfect. We still open ourselves up to significant risk, which leads us to the second question we have to ask ourselves. Because there's an inherent problem with identifying stocks based on those with strong historical revenue growth. Having a 5-year revenue growth above 50% is like standing in a town square and handing out wads of cash. Everyone's going to notice you, and the longer you do it, the more people are going to notice. When a company has seen strong growth for 5 years in a row, people have started to pay attention. And so more often than not, the share price is going to reflect that. So the question is, if we're filtering them down to companies that everyone knows is doing well, how do we make sure we're not investing in already overvalued stocks? Surely investing in the stock market is all about finding those small unknown diamonds, right? Well, actually no. It's not. Investing is all about finding companies that are very likely to grow. And history tells us it's often the best known companies with the strongest financial foundations which are best positioned for continued growth. Smaller companies can do it, but the risk of losing money on your investment is so much higher even if the company does well. Let me show you a really interesting example. This is Fever-Tree. It's a tonic to make gin and tonic. And in 2014, this company went public and its share price exploded. And for seemingly good reason, this UK brand popped out of nowhere and absolutely dominated the tonic market. The share price went up 2,000% in a matter of 4 years, but since then they've dropped back down around 80%. And the really weird thing is, Fever-Tree actually solidified its place as the market leader in the UK. You'll find Fever-Tree in every supermarket and almost every pub in the country. It's a hugely successful business, but their fundamental finances never justified that valuation. And when the market realised, their share price plummeted. In 2014, they were one of those small cap diamonds and one of the few who actually go on to achieve their ambition of becoming market leader. But their share price since 2014 is still only up around 300%, which sounds good, but if we look at Apple since 2014, which even at the time was one of the best known, highest valued companies in the world and had been for a very long time, its share price has 10x since then, over a 1000% increase. And at no point over those 10 years would anyone have seriously said Apple was a risky investment. When you can get that kind of return from a low risk investment in one of the largest companies in the world, it shows how totally unnecessary it is to risk your hard-earned cash on investments like Fever-Tree. People are paying attention to these high revenue growth companies because those companies are brilliant businesses. But the side effect we have to deal with is that for these kind of stocks, traditional valuation metrics are not going to be very useful. If a company has a 5-year revenue growth above 50%, then it's very unlikely that metrics like the price to book or price to earnings are going to be low. But that doesn't mean the stock is overvalued, because what we need to do is use a valuation metric that acknowledges a company's growth rate. And the perfect one is the PEG ratio, which is like an elevated version of the PE ratio. In this case, we assess the company's share price earnings to get the PE ratio, and then we divide that by the company's expected earnings growth. What we're left with is a number that allows us to assess the share price valuation, taking into consideration the expected growth in earnings. This is a metric developed by the legendary growth investor Peter Lynch, and typically a company with a PEG ratio of less than 1 is thought to be undervalued. So to find fairly valued or undervalued stocks with a high revenue growth rate over the previous 5 years, it would be reasonable to look for stocks with a PEG ratio of less than 1.5. And when I applied that to our list of 2019 stocks with a 5-year revenue growth above 50%, we're left with just 11 stocks remaining, with an average share price growth rate since 2019 of 225%. And this time, every single one of them experienced a share price increase. None of them decreased in price, with the lowest being 64% and the highest being 1,204%, which is pretty awesome considering all we've done is apply 2 very sensible metrics. But there is one final thing we can check to increase our chances of success even more. So let's take a look at that now. So I just said this last thing can increase our chances of success, but it's probably more accurate to say it'll decrease our chances of failure. Because when we're looking at fairly valued high growth stocks, we want to make sure that growth is sustainable, even if market conditions change. As Warren Buffett said, rule 1 of investing is never lose money. And rule 2 is never forget about rule 1. The point here is to try and ensure that the companies you're planning to invest in are protected from things like economic shocks, market changes and developments, and increased competition. Now in truth, there are lots of different ways we can do this, whether it be a numerical financial approach, such as assessing the debt levels in the company or forecasting the macroeconomic outlook, or a more qualitative analysis of competitor products and shifting consumer demand. But there's one thing that will help a business overcome any of these potential obstacles, and it's the thing that at the end of the day, every business is trying to generate: cash. Or more specifically in this case, positive cash flow, which simply means a company has more cash flowing into the business than flowing out of it. In turn, that gives them more cash to reinvest if needed. It protects them against economic shocks, it allows them to develop their products and services in line with changing consumer demands, and it reduces their reliance on debt. A company with negative cash flow can still grow, but it's going to be reliant on some kind of external financing, which can dry up very quickly when times start to get tough. So we simply filter out any businesses in our list that were in a negative cash flow position in 2019. And it was actually just one of our remaining 11, but after doing that, we're left with 10 high growth, fairly valued companies in a positive cash flow position. And the result is a list of great stocks, which on average have experienced a 236% share price increase since 2019, with the lowest being 64% and the highest at 1,204%, and a median of 140%. And no doubt you'll recognise a fair few of them. These three metrics work so well together because they help us identify great robust businesses which have a history of growth and are reasonably valued. And there are still plenty of stocks today that match all three of these criteria. So let's jump over to investor52.com and take a look at an interesting example which might surprise you. Here we have one of America's most well-known companies, and here we can see its financial metrics color-coded, with green representing best in sector and red would represent the worst, although this company has no red metrics. But let's focus in on the three metrics we've just talked about. First of all, its growth figures are mightily impressive. Its sales growth over the last 5 years has been 293%, which puts it in the top 5% of its sector, and that trend is still continuing with the most recent 1-year sales growth of 20%. If we go over to the value metrics, we'll also see an extremely low PEG ratio of 0.79, putting it in the bottom 6% of its sector, and if we look at the strength metrics on the right, we'll see a solid free cash flow figure of $3.9 billion, placing it in the top 20%. All excellent indications that this company is well placed for future share price growth. For full disclosure, I'm not personally invested in this one, although I am keeping an eye on it. But maybe one of the market hesitations on this stock is the impact self-driving cars could have on the taxi industry, because this business is Uber. But personally, I'd be very surprised if this stock didn't experience solid share price growth over the next 5 years.